Okay, so here are 5 steps and tips to purchasing your first home. First one is getting pre-approved. This is when the bank tells you how much you can qualify for based on your financial position. Pro tip, get pre-approved from more than one bank. Some banks' mortgage rates are higher than others. A lower rate means a lower installment, which means that you may qualify for more. So don't just get pre-approved from the bank that you are banking with, get pre-approved from at least 3 or 4 banks. So step number 2, understanding debt service ratio. This is used by the bank to determine if you have the capacity within your income to make payments to a loan or a mortgage. Now some banks have different percentage when calculating debt service ratio, which is also known as DSR. Some banks may say 35%, 40%, or even 45%. So let's say, for example, your salary is $10,000, and let's say the bank is using a debt service ratio of 35%. 35% of $10,000 is $3,500. The bank may give you a loan as long as your monthly installment does not surpass $3,500. Now, what happens if you have an existing loan? So let's say you have an existing loan of a car loan for $2,000. They're going to minus that from your debt service ratio. So $3,500 minus $2,000 leaves only $1,500 left over in your DSR to facilitate another loan. So here's a pro tip. Let's say Bank A uses a debt service ratio of 35% and the customer income is, let's say, $16,000, jointly or single. And let's say the mortgage installment for the house that he wants to purchase is $6,200. If Bank A uses 35% of the $16,000, that equals to $5,600. So it's under the $6,200. It's possible that Bank A may tell him that he does not qualify. However, if Bank B uses a debt service ratio of 40%, 16,000 multiplied by 40% is 6,400. He is still within his debt service ratio because they're using 40%. 40% is 6,004. The mortgage installment for the house he wants to purchase is 6,002. He is still within the debt service ratio, so he may qualify with Bank B, whereas he may not qualify with Bank A because Bank B is using a higher debt service ratio. So step 3, financing. Now some banks may offer different amount when it comes to financing a mortgage. Some may offer 100%, 95%, 90%, or even 80%. Now let's say if the bank offers, let's say 90%, and the property is $1 million for simplicity, 90% of $1 million is $900,000. The bank will only lend you the $900,000 if it is their only financing 90%. What does that mean? It means the difference of $100,000 will have to be your down payment, which you have to have saved. Now another thing, in addition to this, there is something called closing costs on a mortgage, which can include attorney fees, stamp duties, etc. This can go up to another $20,000 to $30,000. Now this is excluding the down payment of $100,000. Here's a quick pro tip. Some banks at certain periods offer mortgage campaigns where they may cover part of the closing costs for you. So it's important to keep your eyes and your ears open for those type of campaigns. Fourth, life insurance. Now there is a misconception that you can take out a life insurance policy for $1 million and go to the bank and borrow $1 million. This is incorrect. The bank requires a life insurance for the amount of your mortgage so that in the event of your premature death, the bank loan is repaid and the debt is cleared. This benefits the family of the beneficiary as they may not have been in a financial position to continue paying the mortgage. And if there was no life insurance in place and the bank was only holding the property, the bank now has the authority to repossess the property if the family cannot continue paying the mortgage installments. Pro tip, don't wait until you're going to do a mortgage to take out the life insurance. It's better to have it 5 years too early than 5 minutes too late. So the fifth step is house insurance. The bank will make it mandatory that your property is insured in the event of a fire or other natural disasters. A pro tip would be insure the property for the amount it will cost to rebuild the structure and not the full value of the property, because remember the land will have value as well. So if the house and the land is valued at $1.2 million and let's say the house was burned down, the cost to rebuild the property is not going to be $1.2 million. the cost to build the property may be $900,000 average, so the insurance should be for $900,000 and not the $1.2 million. That's an additional tip. Now I'm going to do another video giving some advanced tip, but this is just the basic steps in terms of applying for a mortgage. Hope you guys saw value in this.